which is not okay according to Islamic principles. You cannot just trade because you like to trade. You have to trade for a purpose. If you analyze an asset, you do your homework, and you figure out the value of the asset is undervalued, and you are basically thinking that in about 2 months or 3 months that value will be realized, that's fine. But if I'm going to buy it now and sell it 2 hours from now, that I think is something that most faqihs or scholars are questioning, because the merits of this kind of trade is more or less just being a player in the market, and that's not the kind of trading philosophy that Islam promotes. Arbitraging. You have the arbitraging, which is again conditional, okay? It is used to take advantage of price disparities of an asset in several markets, meaning you have parallel markets. You are buying gold in one market and you're selling it in another market. Speculating deals with only one market, but arbitraging deals with 2 markets. You buy from one market, sell it in another. That's also okay according to Islam, but again, as long as you don't create this ma'isir or highly speculative form of trade in the process. So hedging, speculating, arbitraging are all okay, except speculating and arbitraging have to be conditional. As far as selection criteria for the assets are concerned, let's say we are creating portfolio of these instruments for asset management, and we have to have some selection criteria. There are some qualitative criteria, which basically refer to exclusion of instruments or contracts or assets that have more than 5% influence from the following types of businesses. You cannot buy assets or shares of companies or any instrument that has more than 5% effect. Some more extreme faqihs say 0% instead of 5%, but some more flexible faqihs have allowed up to 5% effect by riba-based activities, such as non-Islamic banks. This means like you cannot buy shares of a bank that has more than 5% receivables based on riba, and that's not allowed. So riba is something that should not be involved in any kind of assets that you would like to select, if you're a portfolio manager for that matter. Any asset that somehow relates to alcoholic beverage production, any asset that relates to pork and related products, any asset that deals with gambling, casino and lottery related activities are not allowed. Any asset dealing with pornography and related activities are not allowed. Any asset dealing with weapons production is not allowed. And assets related to tobacco and related activities. And some sects might have their own criteria added to this. Some faqihs might be more relaxed, some could be more sensitive to particular activities, like using illegal labor, for example, for that matter, are not allowed. Questionable biological related activities also are not allowed. Human cloning, for example, is a big issue right now. Is that something Islamically viable or not? So any asset related to these kind of activities are not allowed, or usually are used as screening criteria or selection criteria for portfolio management. Then you have some quantitative criteria. Obviously, you do not invest or do direct business with firms that have the following financial structure. Total debt to trailing 12-month average market cap should be is greater than 33%. In other words, highly leveraged companies. You do not try to deal or do business with them as a part of your screening criteria. Why? Because the assumption is that if you have too much debt, you probably are creating a form of riba somewhere ingrained in your structure, and that's just risky also. Too much leverage is a risky kind of base to be able to deal with. Also, cash and interest-bearing securities divided by trailing 12-month market cap should not be greater than 3%. Again, the concept of riba, potential riba, and paper trade, paper money, these are just concerns that are used as quantitative criteria for selection purposes. Accounts receivable divided by trailing 12 months total asset, again, should not be greater than 45%. Again here, the concern and the worry of having paper trade, too much financial instrument on your books, and potentially the danger of incorporating riba in your structure is something that most and most Islamic boards are concerned about. So these were the qualitative and quantitative features for selection criteria. As far as investment objectives are concerned, let's say you're a portfolio manager, you want to manage a huge asset according to Islamic principles. Obviously, as your objective, one key item would be the maturity of your portfolio, your assets, and you want to set some standards for the maturity or some caps on the maturity. And as you know, you could create a portfolio of Islamic assets and manage them having short-term, medium-term, long-term maturity, and each of them have their own specific risk-return features and instruments available to you. Another objective could be cash flow-based objective, meaning you emphasize the fact that your portfolio of assets must more or less be involved in growth or capital gain, or income or dividends should be emphasized, or growth and income. All these combinations are possible, meaning I like to create a portfolio of Islamic assets that emphasizes only growth. I'm not too concerned about current income or capital and dividends. So you will more or less buy companies or shares of companies or assets that provide you some gain at the maturity, at the end, and nothing in the interim period, which is an objective you could have as investment. Income, some of these pension funds, Islamic pension funds or Islamic funds that want to provide current and stable income will emphasize on assets that provide income, particularly, for example, like ijara contracts provide continuous income up to certain maturity, or shares of companies with good dividends for that matter. Some might emphasize both. We would like to have combination of both income and growth. These are again cash flow based objectives that could be used. Also, liquidity based objectives are important. You want to create portfolio of Islamic assets to manage that have high liquidity. That means you have to employ instruments that are traded in the market easily. Obviously, we do have difficulties in Islamic financial markets in terms of highly liquid instruments, but most highly liquid instruments are short-term instruments and more or less are sukuk-based instruments right now. Medium liquidity instruments and also low liquidity instruments. These are all the objectives that could be used. Risk-based instruments or objectives. High-risk instruments can be set as goals and objectives. Obviously, for that, you will get higher return. Or medium risk or low risk. These are all objectives that could be set in your investment policies in the Islamic asset management area. High risk can be based on geography, asset type, and so forth. Medium risk and low risk also the same. I've been speaking too quickly, too fast because of the last time. I don't know if you all can hear me or not. Anybody can hear me?
Yes, we can hear you.
Good. I'm glad we are not disconnected. Okay, let me continue. The benchmarking issues are important. Meaning, Hello? Let's say I'm a portfolio manager and I like to create a portfolio of Islamic assets. I will go through my screening process. I will do my objectives. I set my objective. Now I like to say, okay, I create this portfolio. Now, the performance of this portfolio in terms of risk and return, how can it be compared to another performing benchmark? I have to have a yardstick somewhere to be able to see how good I'm doing. And for that, you need the benchmarking concepts, which are extremely important in Islamic asset management. Benchmarking is required as point of reference, as you see on the slide, for pricing the riskiness, determining opportunity cost, relative value, and performance of the Islamic financial instruments. Currently, non-Islamic benchmarks, such as LIBOR, are used for benchmarking Islamic financial instruments. As you know, most sukuk contracts or instruments are somehow based on LIBOR for price, which is questionable, but since we don't have any other reasonable benchmark, they have had no choice except using LIBOR. There are no generally accepted Islamic financial instruments available right now, benchmark instruments available. Basically Bahrain Monetary Authority, Dubai Islamic Financial Center, they have created Sukuk Index, LOB1 in Malaysia, Dow Jones Islamic Index, Financial Times, HSBC, they all have created different indices or benchmarks for comparison, but all have tried to develop these instruments for different particular and specialized sectors. The effort continues. Nothing concrete still exists. The problem that we have in the Islamic asset management area is there is a lack of a harmonized, global, and active Islamic financial exchange platform for initial public offerings and secondary market trading of Islamic financial instruments. We don't have a harmonized, global, or kind of, let's say, a platform where huge volume of these Islamic financial instruments are trading every day, be measured. And if we had that, we could create different types of indices easily and for benchmarking purposes. Right now, we don't have that, and that creates some sort of an inefficiencies in terms of measuring performances of these portfolio of Islamic assets. Investment structures for Islamic assets more or less deal with individual investments through different asset classes, which is pretty straightforward. You don't need any particular structure. An individual can buy and sell or set up these contracts through Islamic means. But the more interesting structures relate to pooled investments, or more or less creating funds, Islamic funds, which is an aggressive and interesting area. When you create a portfolio of Islamic assets so that you can raise funds or sell it to the public, different types of funds and structures can be designed, and the lists are varied. You can see them. What you do in this area is you first create a limited liability company or a special purpose vehicle to be able to buy these assets through Islamic criterias or procedures, and then try to sell shares from special purpose vehicle or company or limited liability company. The next important issue in the pooled investment area or fund creation structure obviously would be governance structures, meaning the relationship between the board of directors and audit committees and also the Sharia committees and the fund managers have to be clearly defined. This is particularly important in Islamic structures and Islamic finance, that the governance related concepts have to be well designed and well and clearly explained. What is the role of board of director in these funds, the audit committee, and also Sharia committees and the fund manager? Very, very important, a very interesting and challenging area also for many experts to design required structure. As you know, Islamic principles, the fund manager here more or less will be acting as an ameen, and the relationship between the fund manager and the shareholders also is an important area that needs to be clearly defined. Transparency, accountability through the development of codes of conduct, compliance programs, and due diligence structures for the fund also becomes very important. When I say very important, doesn't mean that in non-Islamic funds these are not important, but in Islamic funds there is special emphasis on these issues to again try to get rid of Maisir and Qarara concepts. We have different types of Islamic funds. You have commodity funds, which are more or less short term. You probably would not see some of the things that I've added in this next two slides. You might want to write these added information that I've put in the next two slides. The types of funds in Islamic world that are more or less pretty much live and active include commodity funds, more or less short-term funds, and that is a kind of fund that deals with metals, oil, gas, agri-products, and they trading them and they buy those assets shares of them or through various musharaka or trade-based contracts. Also, in these funds, you're not allowed short selling, meaning selling something without owning them.